Gold and silver have both been fantastic performers in 2025. Gold is up over 60% on the year. Silver double that at over 120% for the year. But the question now is, what happens next year? Where do we go in 2026? Can we continue to push higher? Can we continue to make new highs? Can we continue the trajectory that we're currently on, and how we should be positioned to take advantage? My name's Ray Gilmour, and in this video I'm going to take a look at what's happening under the surface in gold and silver and set out my plan of how we should approach the metals as we head into 2026. The first thing I want to take a look at is actually the seasonal pattern for silver and gold. The reason why I want to do that is because the software is picking up a very interesting pattern. Now, what we can first do with the software is, by using TruePath, we can ask the software to identify all years that are aligned with current price action that are in the market. And we have silver here, and you can see all of the years that it's brought up that are closely aligned with what we have done so far this year. And you can see the blue line is the seasonal average of those years. And we see a very similar movement to what we have done this year. That's a relatively slow start in the first half of the year and a big acceleration in the second half of the year, particularly right in this phase that we're currently in. So we can see that correlation very, very strong with those years. But I want to isolate it even further. I actually want to isolate and take a look at this year here in particular, 2010. And it's one of the years the system has identified that we are currently following. So if I clear all of them and bring up 2010, we can see there's an incredibly strong correlation between the yellow line and the blue line. The yellow line being the closing daily price so far through 2025. The blue line is the movement that we had in 2010. Very similar to the previous seasonal pattern we just looked at, but now this is just 1 year. But again, very similar to the first half of the year, slow grind to the upside as we start the year. Then we have the range bound through the summer and a strong acceleration towards the latter part of the year. Now, why am I looking at 2010? That is where we start to see some issues with silver and gold. If we zoom out here in silver, this is why I'm looking at 2010. This is the action that we're currently seeing in silver and in gold, and that is the action we've seen back in 2010. So the software has identified that the current movement we have in silver is almost identical. In fact, if we can go back over and look at the correlation, there's an 80% positive correlation between the current year and what we did in 2010. And we can see that nature. We can even see visually there's a very strong relationship between the two. We have the same in gold. Also, bring over and take a look at gold. And again, I'll just bring up the 2010 year. We can see again straight away a very, very strong correlation. The move earlier in the year, the range through this middle part of the year, the acceleration in Q3, and actually then starting to taper off towards the end of the year. Very, very strong correlation between both metals between 2025 and 2010. So what does that tell us? It tells us we need to be a little bit more cautious. There's gold and silver, whilst crypto has definitely, the shine is off Bitcoin. There's a lot of money being taken off Bitcoin. There's now a lot of money from retail in particular, a lot of money in professional money as well in gold and silver, but retail are piling in this latter stage of the move. It's becoming a very attractive proposition. There's a lot of money flowing into the ETFs, but we got to be realistic about the chances and the opportunities that we actually have here. If we look at the price action and we take a look, actually we go back to 2010, you can see the nature of, and this is how a market moves. It's not just isolating one move here in 2010 for silver. This is how markets move, particularly as they move to the upside. We have an uptrend here, but there's not much momentum in it. There's not much belief in it. There's not a lot of volume in it. We slowly start to break out, and you can see the price action is relatively weak as we initially break out, and it starts to get a bit stronger. But again, sellers are in there trying to take some profit, not believing we have that real momentum and desire to push higher. But then as we have that little correction, we start to move higher again, and then we take out the highs, we start to accelerate, we get more belief, more money piling into the market. Then we start to see price action accelerating. Look at the price action, the candles getting larger, and then we get even larger towards the end. So notice particularly this last period here, this is a weekly chart. You notice those last 3 weeks, they're the biggest movement we had in all of the moves since we made the low in here. This is pretty much two years of price action, 2 years of movement. If we fast forward to where we currently are, very, very similar, maybe breaking out of the lows. There's not much belief initially. We're pushed forward slowly, we retrace slowly, forward slowly, retrace slowly. And even if we start to break out and take out the highs, you can see not much momentum. Initially, it takes us a bit of time, several weeks to actually get conviction in the market. Then we start to see a bit of an acceleration, a little bit of a profit taken again, a bit of a retracement. And as traders see them, we're not seeing a sell-off. It's just a bit of profit taking, piling in on the long side. And again, notice 3 weeks, maybe take that one out in the middle, but certainly this first candle and the third there, much larger than any we've had in the entire move. And again, that's very symptomatic of a market that's starting to see exhaustion in its price. We're seeing very similar in gold also. If you go back into 2010, into 2011, we've seen the trend very, very consistent and stable earlier. Then it starts to accelerate, and particularly the big acceleration here with the longest move, some of the biggest candles in this area. And that's a very exhaustive sign, and we're actually already in that stage at the moment. We can see the acceleration as we move through the trend. We start to get a bit stronger here, starting to consolidate. Big break to the upside, a lot of strength, a lot of momentum, and we actually get the biggest weekly candle here right at the top here at 40 as we touch 4,400. The signs are there. We are following the pattern that we've done in 2010 in both metals. Price action has shown us this very similar exhaustive action that we typically see as a market is coming in towards the end of that trend. And something else we can take a look at is we actually take a look at the positions data, the commitment to traders data for silver. We're starting to see some major cracks under the surface. As we see this acceleration to the upside, you'd expect a lot of money, and I mentioned that money being in there, both retail and professional money. But the big issue, the main issue is down here, we have the positions for non-commercials. This is your hedge funds, your professional trend following, trying to take advantage of what we have here in silver. And they had been heavy buyers down in the early stages of this. Heavy buyers as we start to see that momentum to the upside, but you'll actually notice they've been coming out of this market. During this phase, we've seen this acceleration over this last couple of months. They've actually been coming out of this market. Again, that's very symptomatic of a market that's coming towards a major peak. And another major concern, not just that professional money is actually leaving this. If we go down and take a look at the little guy, known as non-reportable here in the futures positions, they are retail positions. They are the ones that are still holding very large positions on the long side in silver. They are the main group that is still, as a percentage, they're obviously smaller, but in terms of the percentage of buying that they are doing, they're the only group that are still holding a large percentage on the long side. And I wouldn't be surprised if we actually see that tick up in the next week or two, and it's something to be very, very cautious and worried about. If this was to tick up and actually push up towards 40,000, which we could do in the data released this week or next week, that'll be a major warning and a major symptom of a top coming in here. And the reason being, if we just look back historically, whenever we see big money leaving the market in an existing uptrend, you could see back here in 2010, very similar to what we have here. Professional money is actually leaving the market in the latter stages of the trend, and we see that acceleration at the end of it. At that point in time, actually, the non-reportable retail traders are actually adding in as professional buyers are leaving. And they are all in long right here at the peak. And we see that right through. If you look at where the peaks are in these areas, they're always at a peak in the market at a high in price. And if they're still sitting at relatively high levels, if this is to continue to push higher in the next couple of weeks, that'll be a major sign that silver is actually near a top. So we can see the picture points for both markets. We are following the pattern for 2010, silver and gold. Both of them topped in 2011. The price action is very, very similar to what we had in 2010 in both markets. The positioning, particularly for silver, is very much in line with what we did again back in 2010. So the smart way to prepare for 2026 is to prepare for a correction in both markets. Silver most likely will be a lot more aggressive. If you look back through the history on the chart, you will see silver corrected a lot more violently than what gold does. And that's quite typical of silver as well. It's very aggressive in its nature, particularly whenever it sells off. I'm not saying to ditch everything that you own in terms of gold and silver. If you're in long, you've been buying ETFs, maybe you've been putting some of your pension towards metals as well, some of the ETFs, etc. That's absolutely fine. They have been one of the best performing asset classes this year. But you got to be smart about it. What is the likelihood of it continuing on the trajectory that it currently is? And that's quite small. The chances of we having another year in 2026 that we've had this year is extremely small. So by all means, stay in your positions. And if you're just trading this, swing trading, or absolutely be looking for daily swings higher, particularly as we head into the start of 2026. I think we can have a little bit of a correction as we move into early January. But mid-January, we should still see a continuation to the upside. So whenever we push into February and March in particular, I'd be getting concerned. That's whenever I would be wary, and certainly I'd have the stop losses up. I'm not just going to expect that we make another 100% or 50% for gold, for example, another 100% for silver, and think we're going to have the same again next year. We've got to protect the bottom line, protect profits. The signs are there. We are clearly following what we did in 2010. The positioning is very negative and could get even more negative very quickly. So that's something I'm going to be taking a very close eye on. So we have to be smart about how we position ourselves. Yes, we want to profit from a market whenever it's performing well. We want to be in a market. We don't like coming out of it too soon, but we also got to have a plan, an exit strategy. Where do we come out? Where do I no longer want to be involved in this market? What price does it need to break below for me to want to come out of this? Those are the things that we should be asking now, not whenever it starts to collapse, not whenever we start to see big moves to the downside, because you'll just be forced to take a lower price than what you would have if you sit and think about it now at this point. So I hope that is useful. You can access all the information on the website, particularly the commitment of traders data. If we'll see released another 2 releases this week, we'll get a big insight to what is actually happening in current positioning. And if that turns negative very quickly, then I will be adjusting my positions in both gold and silver also very, very quickly.